getting ready to buy a house flip, and you need to figure out what your max allowable offer is, what you're going to offer to buy the house. And first, you need to figure out what your profits are going to be. And you hear a lot of different things out there. And this is a question that came up in our solo house flipper community today. Charbel says, what's considered a good deal? I'm currently looking for deals that give me a 20% return on the project. Not sure how realistic that is. Some people are telling me that between 15 to 17% is considered good and 20% is considered a home run. Well, maybe is the answer. And the reality is that percents don't really matter. Either do base prices. All right. So I'm going to show you what we're talking about in the first place, what the profit formula looks like. And then I'm going to tell you the three things that you need to consider, show you why percents kind of break down. All right. So what we're talking about here is the offer formula, which is basically the max allowable offer, MAO, on a house, plus the rehab costs and really all the costs on a project, plus rehab plus profit equals after repair value. That came out well. Okay, so let's just say that you're going to purchase a house for $200K, $50,000 rehab, plus your profit equals ARV after repair value of $300,000. That's $250. All the money that you have in, whether it's your money or money that you've borrowed, you have $250,000 into the deal, and you're going to be able to sell that house for $300,000. This is like minus your real estate commissions and fees and such. So basically, your profit equals $50,000. You had $50,000 of profit. So that's your like actual lump sum of cash that you get to put in, but you had $250K in the deal in the first place. So that means that you had a profit margin of 20%. So that's the profit that you got to put in your pocket, 20%. So that's where these numbers come from. Okay, so I'm going to tell you the three factors that matter when you're trying to figure out how much profit you should figure into your max allowable offer formula. And basically, it comes down to this: your margin. So, do we use price or do we use percentage? The risk that you have, and then the type of lending that you're taking on. All right, so let's go to the margin, the price point, which is the real driver here. Okay, well, it really depends on the type of property, the price point in which you're buying in. So let's just take two examples. All right, I bought a house, Parkview, for $21,000. Probably the best deal I've ever bought. Okay, got a great deal on it because there's a human crap in the middle of the living room, by the way. Windows boarded up and all that kind of stuff, but it wasn't in bad condition. So it was a light renovation. We had to clean out a bunch of mattresses and a bunch of used syringes and some human crap and do some like paint and some floors, and that house was ready to go. So I'm all in at $51,000. Once again, simple math here. We're taking out like other costs like utilities and insurance and all that stuff. And then I have this other house, Pontiac, which I bought for $350,000, took the roof off, built a second story, and that cost me $250,000 of renovation costs. It was a humongous renovation. So I'm all in on that one for $600,000. Okay, so let's just apply the home run, that somebody told Charbel, 20%. So 20% on my $51,000 Parkview, well, that'd be like $10,000 is what I would make on the single greatest deal I've ever bought. Not going to cut it, right? Light renovation and $51,000, not going to do it for me. And then on the other hand, Pontiac, where I have $600,000 into the deal, well, if I get a 20% return on that, that's $120K. Fantastic. I would have totally taken that because I lost my ass on that deal. All right, so you have to look at these things differently. And this is the rule of thumb that I use. So I take a minimum lump sum of $30K. I'll never buy a property where I'm going to get less than $30K. And I'll also never buy a property where I'm going to get less than a 10% return on the investment. All right, so let's just apply that to Parkview, which would have been a $30,000 lump sum. All right, that would have been a like 60% return, right? $30,000 divided by $51,000 is like 0.6 ish. So 60% return would have been great. Okay. And then on Pontiac, I'm going to apply the minimum of 30K or 10%. So like 30K on a $600,000 project is going to suck. That's like 5%, but 10% is 60K. Okay. So that's a good minimum standard to look at. Once again, these are just rules of thumb. You have to take some other things into consideration. For instance, the risk profile. All right. So cosmetic renovation like Parkview that has, some poop to clean up and some mattresses, but a cosmetic, does it have more or less risk than Pontiac, which I'm taking the roof off, building a second story? Obviously, the poop living room has way less risk, maybe health risk, but not a financial risk. So on Pontiac, the build a second story, I should be making more profit than the one that is less risky. So I might fudge my numbers a little bit and take less if it is a deal where like got a great deal on the front end and it's going to be, light renovation, like $5,000-$10,000 renovation, and I have it back on the market. I might take a much smaller profit on something like that because I feel safer with it. Okay, and here is the way that I assess risk, right? You guys have seen the scale of livability, but I don't care. I'm going to show you again in case you're watching and you don't follow this channel or are part of the community. All right, so this is the scale of livability. And this line right here is a very important line. This is what we call the livability threshold or the line of livable. So if you are to the right of this line, anything over here, this is livable. And everything over here to the left is not livable. And anytime you try to sell a house, even if it's just right before the livability threshold, you're going to take a huge haircut on it because banks will give you money if you're over here to buy a house. So that means that like normal people, normal families can go buy that house. It is much more valuable than a house that hasn't quite hit the livability threshold. So the further away I am from this threshold, the more dangerous, the more risk that I have. See, if I buy a house all the way over here, I have a long ways to go before I reach the livability threshold. That means I have more risk. And that's why I stay away from new building, because that is the furthest away that I could possibly get from the livability threshold. All right. And then on the other hand, let's take Parkview. Even though it had a poop in the living room, it was a livable house. I just had to clean it up. The mechanical, electrical, plumbing was all working well. It was a cosmetic renovation. A lot less risk there because I can monetize right away. Once again, monetize means I could go sell it or I could rent it to somebody. Great. All right. So risk is another thing that you need to take into account when you're trying to decide how much profit you want. All right. And then finally, lending. When you're buying properties, some of you will have the cash to go ahead and purchase a flip and fund the renovation yourself. I know that sounds crazy to other people who don't have that kind of money, but there are people who have the cash or they have the means to get the cash other than the way that a lot of people go do it, which is like a hard money loan or a commercial loan from the bank. And let me go back to my iPad here. And let's just say that same example where we have, the $250,000. So we're either bringing that via our own cash or we're going to get a loan on it. And if you got a loan on it, you would likely pay something like 12% on the loan. Oh my gosh, my iPad's doing crazy things. You would pay something like 12% on that loan. Okay, so that's 12% over the year. All right, so 12% of 250, you're basically making $2,500 payments every month in interest. And let's just say you held it for 6 months. So 2,500 times 6 months is what, 15 grand? Did I do that right? Yeah. All right, so 6 months. And that's pretty average. Hold a flip for 6 months. And also, you're most likely going to pay some points on the front end when you're getting a hard money loan, but let's not figure that in right now. Okay. But the thing that I'm trying to say is that what a lot of people are doing out there is they are funding a house in cash, and they're including this $15,000 that they would have paid to a hard money lender. This $15,000. They're including that in their formula of their profit. And I just encourage you to think about it like two different businesses. Okay, you have the real estate investor that's buying these houses, and then you have the lender. Okay, so your lump sum of $30,000 or your minimum of 10% should be not figuring in this $15,000. That should get paid to you as the lender. So you have your 10% or $30K. And then you also have your $15,000 because you're getting paid in two different ways. And, this goes even further that, this is kind of how I set up everything. So for me, and I don't want to get you guys confused here, but I have myself as a real estate investor, okay, and I get paid as a real estate investor, my 10% or $30K, and then I get paid as a construction company, cost plus, let's say 20%. That means if that renovation was $50K, around 10,000 of that would have been me getting paid as a general contractor. And, maybe I also get paid as a wholesaler. When I bought that $250,000 deal, maybe 10,000 of that was a wholesale fee. Okay. And then if you're a real estate agent, you get paid as a real estate agent on the buy or the sell side. But you see, these operation companies are separate from you as a real estate investor. Then, this is something that always used to bother me when I was first starting out. People would say something like, oh, well, this will be a great deal for you because you know how to do the construction. This was back when I was DIYing things. And, I used to think, oh, yeah, you're right. Those numbers do check out. But now I realize that, oh, wait, I'm just getting screwed. Like, I'm not getting paid as a real estate investor. I'm only getting paid as the contractor, or vice versa. I'm not getting paid for the time that I put into actually working on the house. Well, that's stupid. If you were getting a hard money lender, you would be getting paid as the hard money lender. So consider it a separate business is what I'm saying when you're figuring out what a good deal is and what is not. So $30,000 minimum, 10% minimum, whatever number is higher. That is a good rule of thumb for you to follow. And if you want to see more about this kind of stuff, I did a whole 7.5-hour free course for folks that want to learn how to become a one-man house flipping business. We also have a school community, which is where this question is getting answered. If you'd like to join, for now, it's free. So come hang out with us. Talk to you soon.